Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025 May-June Paper 2-1 and Paper 2-3 question number 3. This is Paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for the paper is 1 hour and 45 minutes. Since question number 3 is of 15 marks, ideally you should be spending about 17.5 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question number 3 under 17.5 minutes. So without any further delay, let's get started. Khalid, the owner of a retail business, provided the following information. For the years ended 31st December, we have the year 2024 and the year 2023. We have our gross profit margin as well as the profit margin. For the first part, we need to state the formula for calculating each of the following ratios. The first one is gross profit margin. So gross profit margin is just a percentage of the revenue that belongs to gross profit. So that will just be our gross profit divided by revenue times 100, since we have to show the answer in terms of a percent. Then for profit margin as well, it's the same thing, but we use our profit for the year. So instead of gross profit, it will show what percent of the total revenue belongs to the profit for the year. That will be profit for the year divided by revenue times 100. That is all for the first part. Let's move towards the next one. We now need to suggest 2 reasons which would explain the increase in the gross profit margin comparing 2024 with 2023. If we take a look above, we can see that in the year 2023, our gross profit margin was 45%, but in the year 2024, it has increased to 48%. So if we want the total gross profit margin ratio to increase, either the numerator factor should increase or the denominator factor should decrease. So the very first thing is that our gross profit has to increase. And a way to increase gross profit is to reduce our cost of sales, because gross profit is just revenue minus cost of sales. So if we want this value to increase, we want our cost of sales to decrease. Let's write it down. Maybe the reason was that cost of sales was reduced. All right. Then another thing is that if we want our gross profit to increase, then revenue will also increase. So instead of just saying total revenue, we can see that maybe the selling prices were increased, due to which the total revenue increased. Let's write it down. Selling prices were increased. Okay, that is all for the second part. Now for the third one, we need to suggest 2 reasons which could explain the decrease in profit margin comparing 2024 with 2023, despite the increase in the gross profit margin. Okay. So for the year 2023, our profit margin was 13%, but in the year 2024, it has decreased to 12%. And we know for a fact that our gross profit margin has increased. And by that, we're assuming that the gross profit has increased. Now, while calculating our profit for the year, we'll start with the gross profit, then we add other income and subtract all of our expenses. So in this case, the entire profit margin ratio is decreasing, and the reason could be due to the decrease in profit for the year. So if we want our profit for the year to decrease, then it means that either other sources of income should decrease or our expenses should increase. So that is our possible reason. The very first one is that other income was reduced. Let's write it down. Other income was reduced. Okay, then the next thing is that our expenses are increasing. So we can see that our efficiency in controlling expenses is being reduced. Let's write it down. So that is reduced efficiency controlling expenses. All right, that is all for the third part. Let's move towards the next one. We again have some additional information. Khalid has compared the recent liquidity ratios, which compares the cash position of our business for his business with ratios for businesses of a similar size and trading in the same goods. Since we are making comparison with another business in same size as well as in the same industry, the comparison will be valid. In this case, for Khalid's business for the years ended 31st December 2024 and 23, we have the current ratio and acid test ratio, and we have the same thing for similar businesses as well. Now, Khalid is pleased with the results of this comparison. We need to explain with reasons whether or not you agree with Khalid's view of his business's liquidity position. Justify your answer by commenting on both ratios. Okay, this is a 5 mark, so we need 5 different points and then a final decision on whether or not we agree with Khalid's view of his business's liquidity position. Okay, let's take a look at our ratios. For current ratio, the ideal value would be between 1.5 is to 1 to 2 is to 1. And for acid test ratio, the ideal value would be 1 is to 1 because we need to have enough liquid current assets to cover all of our current liabilities. Now let's take a look at the values. In the year 2023, the current ratio was 1.45. It has increased to 1.6. And if we compare it to another business, it's a bit lower, but still we're on the safer side because the value that we require is higher than 1.5. And that is achieved in the year 2024. As for the acid test ratio, the value in 2023 was 0.75 and it has decreased to 0.62. So this is not something that we are pleased with because for acid test ratio, we need to have enough liquid current assets to cover the current liabilities. And as for another business, the value is 0.5. So if we are comparing it to another business, then sure, the value is good enough. But as per our value that we require, it's not really enough. Now, the first thing we can talk about is how the current ratio has been increased. And current ratio increasing means that our current assets has increased sufficiently, so it will be easier to pay any short-term debts, which is our current liabilities. So we have more than enough current assets to cover our current liabilities. Let's write it down. Despite being less than averages, and we're writing being less than averages because we can see for similar businesses, the value is 1.85. And as compared to this value, 1.6 is still lower, which is why we are less than averages for similar businesses. The current ratio has improved, meaning that it will be easier to pay short-term debts. Okay. Then we can talk about how the acid test ratio has been reduced or declined. And we can also compare it to our industry average of 0.5, and comparatively, our business acid test ratio is better. So despite the decline in the acid test ratio, liquid assets are being used more efficiently and it is now operating at nearer the average for this type of business. And in this case, we talked about how the liquid assets are being used more efficiently because we can see that the acid test ratio has decreased. And for acid test ratio, we use all of our liquid assets such as cash in hand or cash at bank, except for all of our closing inventory. So we also utilize the trade receivables value. And what this means is that instead of just letting the cash sit idly in our bank account, we might have made investment, and that could turn the current asset into a non-current asset. And that's what it means by liquid assets are being used more efficiently. And as a result, the acid test ratio value has decreased, which makes it more nearer to our industry average of 0.5. That's the second point. Now we can talk about the averages. So the current ratio remains below the average for similar businesses, right? Because the average is 1.85, whereas it is below at 1.60. And as a result, we might have difficulty in paying short-term debts. Let's write it down. The current ratio remains below the average for similar businesses, indicating that it may continue to have difficulty paying short-term debts. Okay. Then for the last one, we can again talk about asset test ratio, where it remains above our industry average of 0.5, indicating that the liquid resources are not being used efficiently. So we could have still used other liquid assets as well efficiently rather than letting it sit idly in our business. So the asset test ratio remains above the average for similar businesses, indicating that liquid resources are not being used efficiently. Okay, now we need to explain with reasons whether or not you agree with Khalid's view of his business's liquidity position. And Khalid was pleased with the results of this comparison. And in this case, I would have to agree with Khalid as well, because as for the current ratio, it's still higher than 1.5, which means that we have more current assets to cover our short-term debts, which is the current liabilities. And even as compared to our industry average, it's not far behind. We're only behind by 0.15. And that does not indicate that the business is not doing well. As for the asset test ratio, in this case, we're talking about more liquid assets except for our inventory. And we have a value that is still higher than the industry average. And since the value is less than 1, we can still see that the liquid assets are being used more efficiently. And as compared to the values of our similar businesses, we're still doing better. So I'd have to agree with Khalid's view of his business's liquidity. Let's write it down. I would have to agree with Khalid's view of his business's liquidity, because the current ratio has improved in 2024, because previously it was 1.45 and now it is higher than 1.5. Higher than 1.5, and the asset test ratio has declined in 2024 while still maintaining a higher value than that of the industry average. All right, that is all for this part. Let's move towards the next one. We again have some additional information. Khalid is aware that size of business and trading in similar goods are not the only factors to be considered in making comparisons with similar businesses. We need to explain two other reasons why Khalid may find it difficult to make valid comparisons with similar businesses. So the very first thing is businesses may have used different accounting policies, and as a result, comparisons cannot be valid. Let's write it down. Businesses may have used different accounting policies so that comparisons cannot be valid. And another reason why he may find it difficult to make valid comparisons could be because they can have quite different asset structures. And in some of our ratio calculations, we use the value of our non-current assets as well. And if they do not belong to a similar structure, then that comparison might also be invalid. Let's write it down. Businesses may have different asset structures. And by asset structures, it means that maybe one business uses a lot of computer equipment, whereas another business is more focused towards machinery. So that comparison might not be valid. Making comparisons of certain ratios invalid. Alright, that is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.